Think for a moment about the global financial system, this invisible web that underpins pretty much all international commerce. For almost a century, one currency has been right at its center. It's a system most of us just take for granted.
Right. It just sort of is.
Exactly. But what if this foundation isn't as stable or maybe as impartial as it seems? That's really the central question for our deep dive today.
A big one.
It is. We're going to explore the existing international monetary and financial system, trace its historical roots, where it came from, and look at this growing movement that's advocating for alternatives.
A movement gaining some real traction lately.
Absolutely. And for you, our listener, if you want to grasp complex issues quickly, thoroughly, this deep dive is really designed to cut through the noise and deliver just that.
So where do we start? You mentioned historical roots.
Yeah, let's go back. Because much of today's financial order, the blueprint for it, was actually drawn up at the Bretton Woods Conference. We're talking 1944.
Ah, yes, Bretton Woods. A pivotal moment. It really highlights the significant influence of Western economies in shaping how global finance operates even today.
And the key outcome?
The key outcome was establishing the U.S. dollar as the world's reserve currency. Now, this wasn't just a technical decision, right?
No, it sounds fundamental.
It was. It gave considerable power to the United States, including, importantly, the ability to effectively veto decisions within major international financial institutions like the IMF and World Bank.
Okay, let's unpack that. The dollar is the reserve currency. What kind of tangible power did that actually give the U.S. beyond just, prestige?
Well, if we connect this to the bigger picture, that status gave the U.S. unique leverage. And over time, it's evolved into something, frankly, beyond pure economics.
How so?
Washington has increasingly used the dollar in ways that have pretty significant geopolitical implications. I mean, currently, a substantial number of countries. It's remarkable, about a third of all nations.
A third? Wow.
Yeah, including a significant chunk, maybe 60% of poorer countries, are subject to U.S. sanctions. These are often unilateral actions, too, which, sparks debate under international law.
A third of the globe facing U.S. sanctions, that's a massive figure. And it's not just about restricting trade, is it? We've also seen assets being frozen.
Precisely. The freezing of assets belonging to various countries has become another tool in this geopolitical toolkit. We're talking vast sums.
How much are we talking?
Hundreds of billions of dollars in reserves held by central banks. Think nations like Russia, Venezuela, Afghanistan, Iran, Libya, Syria, North Korea. The list has actually grown quite a bit over time. It really shows the reach of this particular lever of power.
So the U.S. wields this considerable financial power. What's the direct economic advantage for the U.S. itself? What does it get from the dollar being the world's reserve currency?
Here's where it gets really interesting. The dollar's status provides the United States with what's often called an exorbitant privilege.
Exorbitant privilege, I've heard that term.
Think of it like the world effectively giving the U.S. an interest-free loan year after year. It's a privilege no other nation enjoys, and it inherently creates imbalances in the system.
How does that work in practice?
Well, it allows the U.S. to sustain large budget deficits and, in essence, draw in wealth from across the globe. The U.S. can, increasingly just digitally, create more dollars to pay for its imports.
While other countries.
While other nations, especially developing ones, often need to extract resources, work hard just to earn those same dollars for their own international needs. This system has undeniably benefited certain sectors within the U.S., think Wall Street, affluent individuals, but the impact on developing countries can be, markedly different.
It paints a picture of a system that maybe isn't as universally beneficial as one might assume on the surface. So who's pushing for change? Who's advocating for something different?
That's the crucial question, isn't it? And the answer significantly lies with the BRICS nations.
Okay, BRICS, Brazil, Russia, India, China, South Africa originally.
All right, and now expanded. We've got Ethiopia, Egypt, Iran, the UAE, Saudi Arabia joining the fold. It represents a growing coalition that's really seeking to reshape the international monetary and financial system.
What's their main goal?
Their goal is to foster a system that provides more equitable opportunities, particularly for developing countries, for the global south. And it's important to note, within BRICS, all members operate as equals. There's a rotating chairmanship.
And who's in charge now?
In 2024, Russia holds that position. And actually, a significant report was prepared by the Russian Finance Ministry and Central Bank, specifically for the BRICS summit in Kazan this October. It outlines their plans for this fundamental transformation.
Okay, so BRICS has this stated aim. What's the central pillar of their proposal? How do they plan to actually bring about this change?
At the core of the BRICS proposal is something called the BRICS Cross-Border Payment Initiative, or BCBP for short.
BCBP.
The fundamental aim here is to reduce the reliance on the U.S. dollar in trade, in international investments, in the reserves held by member nations, essentially to de-dollarize these key economic activities.
So less dependence on the dollar means.
By lessening their dependence, BRICS seeks to diminish its dominant role and establish viable alternatives. This initiative is seen as a pathway to free developing countries from relying so heavily on the U.S. dollar and, critically, from the reach of U.S. sanctions.
So the strategy involves building their own infrastructure then to facilitate transactions that bypass the dollar.
Exactly. The plan includes establishing new infrastructure specifically designed for cross-border transactions using national currencies. Just imagine the potential relief this could offer developing countries.
Which often struggle to get hold of dollars, right?
Precisely. They often struggle to access hard currency like the U.S. dollar, which is essential for international trade and, frankly, maintaining the stability of their own currencies.
We often hear talk, sort of whispers sometimes, about a potential BRICS currency. How does that fit into their immediate plans? Is that part of the BCBP?
It's fascinating. That topic comes up a lot. But the report prepared for Kazan suggests it's more of a medium to long-term goal. It's not the immediate focus.
So not ruling it out, but later.
Exactly. One possibility mentioned as a potential foundation maybe down the line is using special drawing rights, SDRs.
SDRs, those are the IMF's things, right?
Correct. They're international reserve assets created by the IMF. Their value is currently based on a basket of 5 major currencies, mostly Western ones, plus Japan and China.
Okay, so if a single currency is longer term, what are the more concrete steps BRICS is proposing in the near to medium term?
In the short to medium term, the emphasis is really on constructing new institutional frameworks and, importantly, making existing ones more democratic.
How would they do that?
This involves fostering direct connections between commercial banks within BRICS member countries and, crucially, between their central banks, too. The objective is to enable the settlement of trade imbalances directly in their own national currencies, bypassing those traditional dollar-based channels.
And are they looking at new technologies to make this shift happen? Seems like tech would be key here.
Absolutely. Exploring cutting-edge tech is central to the proposal. They're seriously examining distributed ledger technology, DLT think blockchain.
Right, blockchain.
For its potential to decentralize financial networks. And also, central bank digital currencies, CBDCs, are being considered as a mechanism for direct settlement between central banks. It offers a potentially more streamlined, maybe more secure approach.
It sounds like they're trying to address some pretty fundamental weaknesses or maybe perceived weaknesses in the current global financial structure. What are the main inefficiencies they point to?
The report is quite critical, yes. It highlights the system's its monopolistic nature and the significant influence wielded by the United States.
The dollar monopoly again.
Yes, and this dominance, they argue, even extends to the U.S. legal system having considerable sway over global finance. BRICS aims to establish a more democratic system, using modern tech to make transactions faster, more transparent, safer, and significantly cheaper.
Cheaper? How much cheaper?
The report actually estimates potential savings in the tens of billions of dollars annually just for BRICS members, simply by reducing the fees tied to current settlement processes.
Wow, okay. So we've discussed the what and the how of the BRICS plan. Let's pivot slightly to the why. What exactly are BRICS' overarching goals in pushing for this transformation?
Well, first, it's important to clear up some common misunderstandings. BRICS isn't a military alliance, right?
Not like NATO or anything.
No. Nor is it some kind of rigid, hierarchical international organization. As Russia has emphasized, it's a multinational union of equal members, built on principles of equality and mutual respect.
Okay, so what holds it together? What are the pillars?
Their cooperation is structured around 3 main pillars: politics and security, economics and finance, and cultural and humanitarian cooperation. All are important, but arguably, the economic and financial aspects are the primary drivers behind a lot of their collaboration.
So it's fundamentally an economic and developmental initiative at its core.
Precisely. BRICS serves as a platform for developing and formerly colonized countries and also nations like Russia that have faced significant economic disruption. It's a mechanism for these countries to collectively foster economic development, boost cooperation in trade and investment, push forward infrastructure projects, and promote scientific exchange.
And providing an alternative to existing institutions.
Critically, yes. BRICS aims to create alternatives to the existing Western-dominated financial institutions, offering a different pathway for growth and stability.
You mentioned earlier this connects to a longer history, calls for a more equitable global economic order. Can you elaborate on that historical thread?
Yeah, it's fascinating when you put it in context. BRICS can definitely be seen as a contemporary expression of aspirations going back decades. Specifically, it echoes the 1974 call for a new international economic order, the NEO.
NEO, okay.
This was a demand voiced by formerly colonized nations in the Global South, and it's been consistently reiterated ever since by the G77 group.
Which is much bigger than 77 now.
Much bigger, yes, now 134 countries. Their central demand, consistently, has been the democratization of the global financial system. The fact that BRICS, 50 years later, is putting forward a tangible plan to achieve this, that makes it a development with some real historical weight.
And at the heart of this historical push and the current BRICS plan is this core idea moving away from the dollar's dominance.
Absolutely. The core mission remains to de-dollarize, to challenge the U.S. dollar status as the primary global reserve currency. The goal is to empower countries to increasingly use their own national currencies for cross-border trade and investment.
What would be the effect of that?
Well, this shift could reduce their reliance on buying U.S. Treasury securities just to hold reserves. And, perhaps most significantly, it could lessen the United States' geopolitical leverage, the leverage that comes with the dollar being so central to global finance.
We've talked a lot about the theory and the plans. Are we actually seeing any real-world examples of this de-dollarization trend happening already? Is it just talk?
No, definitely not just talk. We are indeed seeing it. This isn't just some future dream. De-dollarization is happening in various forms right now. A really notable example is China.
What's China doing?
As of 2023, China actually settles a slight majority of its cross-border transactions in its own currency, the renminbi or yuan.
A majority. That sounds like a big deal.
It is a significant shift. Compare that to 2010, when over 80% of its international trade was done in U.S. dollars. That's a huge change in just over a decade.
Okay, that's China overall. Are there specific examples of countries using their own currencies in trade deals with each other?
Certainly. If you look at bilateral trade relationships, the trend is even clearer in some cases. Russia reported, I think it was April 2024, that over 90% of mutual payments with China are now done in rubles and yuan.
90%, wow.
Yeah. And similar agreements to use national currencies are in place between Russia and India, Russia and Iran, and also China and Brazil.
Brazil's leader, President Lula, has been quite vocal on this, hasn't he?
Absolutely. President Lula Silva has been a really strong advocate for reducing reliance on the dollar. During a visit to China in 2023, he actually publicly questioned why all nations had to base their trade on the dollar.
Where did he say this?
He was speaking at the new development bank, that's the BRICS Bank, based in Shanghai. He suggested exploring trading in their own currencies. And interestingly, the current president of that bank, Dilma Rousseff, has also pledged to increase lending in local currencies.
What's their target?
Aiming for 30% in the short term, with a longer-term goal to eventually potentially eliminate dollar use in their lending altogether.
And it's not solely a BRICS thing, is it? You mentioned other regions are exploring similar ideas.
That's correct. The movement goes beyond BRICS. In Africa, you've got the Pan-African Payment and Settlement System, PSPS, aimed at facilitating cross-border payments in local African currencies.
And Southeast Asia.
Similarly, in Southeast Asia, the ASEAN member states signed an agreement in 2023 to connect their payment systems, again, to promote using local currencies in regional trade.
So it seems like a widespread trend.
It underscores this growing global desire, particularly among developing nations, for alternatives to the U.S. dollar-dominated system. They're seeking greater economic autonomy.
Okay, let's circle back to that key report prepared for the BRICS summit. Can we delve into its core arguments and the specific proposals it puts forward for actually transforming the financial system?
Right, the report. Its central argument is basically that the current international monetary and financial system isn't just unfair or unjust, but it's fundamentally inefficient and outdated.
Outdated how?
They argue it's essentially a 100-year-old structure trying to cope with a 21st century global economy. A core problem identified is the excessive reliance on a single currency, the U.S. dollar, and a centralized financial infrastructure.
And this harms developing economies.
Yes, it disproportionately disadvantages emerging markets and developing economies, EMDEs, as they're often called.
The report also mentions something about capital flows, how money generated in developing countries often ends up elsewhere.
Yes, that's a particularly revealing part of the analysis. It highlights how profits from growing trade in EMDEs frequently get invested abroad, mostly in richer Western economies where markets are more liquid.
Instead of being reinvested locally.
Exactly, instead of being reinvested back into the developing countries themselves. This leads to a net outflow of wealth from the global South's capital that's desperately needed for domestic development, for industrialization.
And the report suggests this isn't accidental.
It suggests the inherent structure of the system, largely set up by Western powers, kind of perpetuates this pattern, benefiting them potentially at the expense of others.
And recent global events, trade tensions, the conflict in Ukraine, have these made things worse?
Absolutely. The report emphasizes that recent geopolitical developments, the new Cold War talk, U.S.-China tensions, the widespread use of sanctions, the Ukraine conflict, all these have contributed to a fragmentation of global trade.
Making the need for alternatives more urgent.
Precisely. This fragmentation has created a more pressing need for alternative cross-border payments infrastructure that can offer a viable alternative to the current model, which relies so heavily on centralized settlement and that U.S. dollar monopoly.
So what kind of alternative infrastructure does the report specifically propose then?
It proposes developing the future of cross-border payments around two main ideas. First, establishing a new messaging system as an alternative to SWIFT.
Replacing SWIFT.
Or at least providing an alternative. SWIFT, of course, has significant ties to the U.S. Second, creating a new network focused on settling transactions in national currencies.
How would that network function?
It would aim to connect commercial banks globally for local currency deals, and importantly, establish direct links between central banks. That direct central bank connection is seen as crucial for minimizing risks and potentially getting around sanctions.
And this links back to the BCBP initiative we talked about earlier.
Exactly. The report goes into more detail on the BRICS cross-border payment initiative project, which the Bank of Russia presented. The core goal is a common multilateral settlement platform using modern tech to cut risks and speed up payments.
Beyond just payments, does the report also talk about changing things in the investment world?
It does. Recognizing that you need to reduce dollar reliance not just in trade but also investment, the report calls for creating new investment vehicles and financial instruments within BRICS countries, denominated in their own currencies.
Why is that needed?
It points out the inefficiencies because capital markets are so centralized in the West. Often, an investment between two developing countries has to go through London or New York.
Seems inefficient.
Right. The report advocates for decentralizing this and fostering direct cross-border investment among EMDEs.
And this leads to that BRICS Clear platform idea.
Exactly. The report proposes setting up the BRICS Clear platform. It's envisioned as an electronic system for interdepository interaction.
Meaning?
Basically a way to facilitate direct investment flows between BRICS and developing countries, bypassing those Western intermediaries. It aims for automated, secure record-keeping for securities transactions, free from unilateral interference like sanctions.
The report also mentions central bank reserves, right? The fact that everyone still holds so many dollars.
Yes, it addresses that. It acknowledges the dollar's dominance, but emphasizes that the interests of the U.S. as the issuer aren't always aligned with everyone else's. It calls for diversifying reserves, suggesting there needs to be more viable alternative currencies and assets available.
And it criticizes the existing development funding model, too, like the IMF and World Bank.
Yes, there's a significant critique there. It highlights the paradox. Developing countries needing investment most often face higher interest rates than richer nations.
That doesn't seem right.
It's a key concern. The rising burden of interest payments on government revenues in the global South is pointed out. The report also criticizes the perceived undemocratic governance of the IMF and World Bank Western nations holding disproportionate voting power and leadership roles.
They compare voting shares.
They do. Contrasting the G7's voting share with their current GDP contribution versus BRICS, highlighting the imbalance. Even the existing BRICS contingent reserve agreement gets critiqued for relying too much on the dollar and needing IMF approval often. They propose reforms to make it a real alternative.
So the overall message on funding is
that the current system perpetuates economic imbalances and hinders sustainable development for many in the global South.
It seems a core argument running through this is that the global economy has changed dramatically, but the financial system hasn't really kept pace.
That's a crucial takeaway, absolutely. The report emphasizes this huge shift. Emerging markets now account for over half of global GDP, driving most of the growth in the last decade.
And BRICS share has grown significantly, too.
Right. BRICS' collective share of global GDP has risen substantially, now actually exceeding the G7 economies. But, the report points out, the fundamental structures of international finance, largely unchanged since the early 20th century.
And this disconnect causes problems.
They argue it contributes to recurring financial crises, persistent trade imbalances favoring certain nations, volatility in capital flows, and exchange rates that hit developing countries hardest. The conclusion is pretty stark. The current system primarily serves advanced economies, worsening global imbalances and hindering sustainable development elsewhere.
Does the report look at how trade and investment patterns themselves are changing, or maybe not changing enough?
Yes, it highlights that trade between developing economies is increasing significantly. It's a big chunk of global trade now.
But investment isn't following the same pattern.
Exactly. It notes a relative lack of similar diversification in international investment flows. A disproportionate amount still flows from developing to developed countries. This reinforces the argument that the system isn't effectively channeling capital where it's most needed for development in the global south.
You mentioned some research suggesting richer countries actually drain capital from poorer ones. How does that fit in?
That research really illustrates these systemic imbalances. It shows how the dollar's dominant position has enabled what's called a rich world privilege. Capital tends to flow out of the global south, including BRICS, towards the global north.
So money flows uphill, in a sense.
In a way, yes. This flow generates excess yield income for wealthier economies, while BRICS countries often end up with a negative yield income, essentially a drain on their financial resources. The scale is significant, impacting GDP in both rich and BRICS nations, underlining these structural issues.
Okay, let's focus on the criticism of the dollar's role in payments. What specific inefficiencies or drawbacks does the report highlight there?
Several key things. First, a lack of competition in this critical infrastructure, despite, all the usual talk about free markets.
Right, ironic.
Second, the centralized decision-making power within the U.S., which tends to mean higher transaction costs for everyone else. And perhaps most significantly, the political risk being potentially excluded via U.S. sanctions.
Even if the transaction has nothing to do with the U.S. directly.
That's the point. The report argues tech should have made things easier, but the system is still burdened by older practices and these political factors.
It specifically mentions the correspondent banking system and SWIFT as problems.
Yes, it details the inefficiencies and risks there. Using intermediary banks, often in the U.S., slows things down, adds costs. And critically, it subjects transactions even between non-U.S. entities using non-U.S. currencies to U.S. laws and potential sanctions. And similar critique: time delays, high costs, and susceptible to U.S. and European sanctions, again affecting transactions that might not involve the U.S. dollar or U.S. infrastructure at all.
So, given all these criticisms, what kind of new cross-border payment architecture does the Russian proposal actually envision? What's the alternative look like?
The Russian proposals, as outlined, are built around two main pillars. One, an alternative messaging system to SWIFT. Two, a network of banks for direct transactions.
Okay, and how would they achieve that? What are the options?
The report outlines four potential pathways. First, a network of global commercial banks doing deals directly in local currencies. Second, direct links between central banks designed to be immune to external political pressure.
That sounds significant.
It is. Third, introducing distributed ledger technology DLT using tokens and CBDCs for decentralization and efficiency. And fourth, maybe more novel, creating centers for mutual trade in commodities, where imbalances could be settled with actual goods, gold, grain, oil, etc.
Interesting. Of those options, does the report favor any particular one?
It seems to suggest that DLT and CBDCs hold particular promise.
Why is that?
Because this tech model could virtually eliminate credit risk, drastically cut processing time and costs, and remove the need for those correspondent banks altogether.
Making it sanction-proof, essentially.
Potentially much more resistant to sanctions, yes. And the cost savings could be huge. But, as the report notes, this isn't starting from absolute zero. Bilateral deals in local currencies are already happening.
Right, you mentioned Russia, China. Any other examples?
India and the UAE trading oil and rupees is another one. It shows these concepts are feasible.
Are there international projects already testing this DLT-CBDC approach?
Yes, definitely. Project Dunbar, led by the Bank for International Settlements, is exploring a multi-CBDC platform with Australia, Malaysia, Singapore, South Africa involved.
And Project Enbridge, I've heard about that one.
Right, Enbridge is perhaps even more significant. It's led by China. connecting central banks of Thailand, UAE, China, Hong Kong, and recently Saudi Arabia joined too. They're using DLT and CBDCs for direct trade settlement, bypassing intermediaries, and SWIFT.
So a real potential challenger.
Financial media like Bloomberg certainly see it that way as a potential challenge to dollar dominance. Interestingly, you also see opposition to CBDCs from places like Wall Street.
Why? What are their concerns?
Partly worries that digital currencies could pull funds out of traditional commercial banks, and also that they could accelerate this whole de-dollarization trend.
Okay, this brings us to the specific BRICS proposals. The Cross-Border Payment Initiative, BCBPI, and the BRICS Clear Platform. What are their main aims?
The BCBPI is designed to speed up and improve cross-border payments between BRICS nations, foster innovation in payments tech, expand financial inclusion, and significantly boost the use of national currencies in both payments and investments.
And the BRICS Clear Platform, what does that add?
That complements it. It's proposed as a new system for securities accounting and settlement, aiming to reduce reliance on the current Western-dominated infrastructure there. It's envisioned as an electronic system for interdepository interaction.
Can you simplify that a bit?
Sure. Think of it as an automated, secure way to record and execute securities trades directly between BRICS and developing countries, bypassing Western intermediaries and immune to unilateral sanctions.
And how would it be governed?
A key aspect is its democratic governance. Rule changes would need unanimous agreement from members. The aim is for it to be open and inclusive.
What are the potential benefits for participating countries or investors using something like BRICS Clear?
Well, potentially access to financial instruments that were harder to get before. It could also encourage more investment in much-needed infrastructure projects within BRICS and other developing nations across Africa, Latin America, Asia.
Any other benefits?
Yes. Facilitating new forms of debt issuance. Moving away from only issuing bonds in euros or US dollars towards bonds denominated in national currencies. This could really help industrialization by letting countries borrow in their own currency, reducing exchange rate risk.
That sounds like a big change.
Could be. There's also talk of a new independent body to assign international codes for financial instruments in BRICS currencies, streamlining things further, and facilitating commodity trading too, maybe even a BRICS grain exchange to settle imbalances with tangible goods.
Okay, another key piece is de-dollarizing central bank reserves. How does BRICS propose tackling that? It seems hard given the dollar's deep entrenchment.
The report acknowledges the dollar's continued dominance, yes, but the approach is presented as gradual, measured. The focus isn't on forcing anyone out of dollars overnight.
So what is the focus?
It's on making other currencies, or maybe baskets of currencies, more attractive as stores of value.
How? What are the mechanisms?
Things like establishing better liquidity protection mechanisms, creating dedicated trading venues for a wider range of currencies. There's also a more discussed proposal, increasing the issuance and holding of local currency bonds as investment options for central banks.
Is that controversial?
It can be. While it might help a country's balance of payments, central bankers often worry about potential currency depreciation if they hold large amounts of less liquid currencies. It's a trade-off.
So are there other proposed alternatives for reserves?
Yes. To help address those concerns and offer another option, the new development bank has proposed the BRICS Digital Investment Asset.
A digital asset backed by what?
Backed by the assets of member countries. The idea is to provide another instrument for holding value.
Let's talk more about the new development bank, the NDB, and this digital investment asset. What's their role in this bigger picture?
Strengthening and expanding the NDB is definitely a central objective for BRICS. Its main goal is helping developing countries with infrastructure challenges.
And the local currency lending.
Right. Its commitment to increase lending in local currencies is key, aiming for that 30% target by the end of 2024. The longer-term vision is to further cut dollar reliance and help transition to these alternative payment and investment infrastructures.
And the digital investment asset fits into that how?
It's intended as another financial tool, partly to increase the NDB's own financing capacity for development projects, thereby reducing the dependence of developing nations on institutions like the World Bank.
Okay, so if we were to synthesize everything we've discussed about the Russian proposal specifically, what are the main takeaways?
The overarching Russian proposal, steering BRICS in 2024, really pushes for a shift to a more multi-currency system. Key tools are the BCBPI and the BRICS Clear Platform. It advocates more investment in local currency assets, using blockchain and CBDCs, though also proposing commodity exchanges. Strengthening the NDB with things like the digital investment asset is vital. and reforming the contingent reserve agreement to make it a genuine alternative safety net. It's a pretty comprehensive vision.
It really is. Okay, finally, let's tackle the big question that's probably on many listeners' minds. Is a single BRICS currency actually realistic anytime soon? And how do all these plans connect to the existing international reserve asset, the SDR?
Right, the BRICS currency question. The report doesn't completely rule it out long term,
Yeah.
but it definitely acknowledges the huge complexities, the logistical hurdles. It frames it as a more distant prospect.
So the immediate focus is elsewhere.
Yes. In the interim, the report discusses the potential for a broader international unit of account to eventually replace the dollar as the sole global reserve currency.
And that brings us back to SDRs.
Exactly. Special drawing rights. As we said, they're the IMF's reserve asset based on that basket of currencies currently Western-dominated, plus yuan and yen.
But they're not widely used now, are they?
No, their use is limited, partly due to lack of market infrastructure, accessibility mainly for governments, and their value is tied to the interest rates of those basket currencies. But, interestingly, the report is generally quite positive about SDRs.
Despite the issues with the IMF itself.
Despite acknowledging the concerns about IMF governance and Western dominance, yes, the report suggests SDRs could play a bigger role. They could help mitigate risks of single-country reserve currencies, manage global liquidity better, maybe even enhance monetary sovereignty for nations.
So the conclusion on SDRs is
That a reformed SDR system has the potential to act as a truly super-sovereign reserve currency. And this could potentially solve the inherent Triffin dilemma.
the Triffin dilemma. Remind us what that is.
It's the contradiction that happens when one country's national currency, like the US dollar, is also the world's main reserve currency. To provide enough dollars for global trade, liquidity, the issuing country, the US, has to run persistent deficits, which can undermine confidence in the currency eventually.
So an SDR-like asset wouldn't have that problem.
Potentially not, as it wouldn't be tied to one nation's economic policy or deficit needs. So the underlying message seems to be openness to a global unit of account. Maybe a reformed SDR, maybe a future BRICS currency as a long-term goal, while focusing right now on building these practical alternative payment and trade mechanisms.
Okay, so to bring our deep dive to a close for you, our listener, the current global financial system, with its long, complex history, has definitely created imbalances, maybe even vulnerabilities.
That seems clear from the report.
And there's a significant movement spearheaded by the BRICS nations that's actively exploring and starting to implement a whole range of alternatives.
It's not just one thing, is it? It's diverse. From practical steps like de-dollarizing trade and investment, building new payment systems,
All the way to these longer-term ambitions of potentially creating new reserve assets and maybe forging a more equitable global financial order.
and what's crucial to grasp, I think, is the significance of these developments. We've aimed today to give you a comprehensive understanding of these complex global shifts, the things happening often just beneath the surface of daily news headlines.
And maybe as a final point to chew on, what are the broader implications? If we imagine a future where the US dollar's long-standing dominance is genuinely challenged, what new opportunities, what potential challenges might emerge? For different nations, for individuals even.
It's a big question, White. It definitely invites more thought about the long-term consequences of the trends we've talked about.
Absolutely. And if you want to dig deeper,
Yeah, this raises some interesting areas for further exploration on your part. You might find it insightful to look more into the new development bank, maybe track the progress of Project Enbridge, or even research the history and goals of that new international economic order from the 70s.
it gives you a richer context. Ultimately, just getting a solid understanding of these really intricate systems, well, that's the fundamental first step, isn't it? Towards having a more informed, more nuanced perspective on our evolving global economy and where it might be heading.